Investment banking basically acts as underwriting. What does underwriting actually mean? An underwriter acts as an intermediary to assist companies in raising capital, typically in the form of equity and debt. Why is this called underwriting? Because they will also do the due diligence to make sure and underwrite, to make sure that the financials are solid. They earn fees as a percentage of the dollars raised. The fees earned equal the underwriting spread. Now, what you really need to know is the fact that, once again, underwriters, investment bankers can be considered somewhat synonymous terms because they help raise capital. An underwriting syndicate simply would be a group of underwriters who work on a particular issuance. Why? Just to raise a lot of money. Mergers and acquisitions, my specialty, basically provides advice on acquiring or selling a firm. This means they have to do valuation, they have to learn how to structure an M&A deal appropriately, and they have to negotiate. A merger, as we know, is considered an equal combination, what we might even call a merger of equals, two similarly sized firms getting married. An acquisition is where typically a larger firm actually gobbles up a smaller firm. And again, how do the M&A advisors and investment bankers make fees? They make the revenue, they earn fees off a percentage of the entire transaction value. There's usually a sliding scale where the larger the transaction, they will get a smaller percentage, but obviously a higher dollar amount. Now, leveraged buyouts, which we'll briefly touch upon when we get to the alternatives and private equity section, is when you use a massive amount of debt, leverage, to buy out a company. Also, part of this advisory section would we also consider the reorganization, restructuring, and distress, in which you advise companies who are in financial trouble to try to get out of the situation and restructure the capital structure so that they're not always going to be in a massive amount of debt that they owe to their creditors. Does size matter? Bulge bracket investment banks. Excellent question. Does size matter? The answer is maybe. Bulge bracket investment banks. The technical definition of bulge bracket investment banks is considered traditionally the largest firms in an underwriting syndicate. That's why it's called the bulge bracket. Bulge for big, and then that little bracket in which the largest firms participating in that particular underwriting syndicate to help issue the equity or the debt. However, the now common layman definition in common language is that bulge bracket simply means the largest and most distinguished and preeminent firms on Wall Street. Within the bulge brackets, there are also several tiers. Tier 1 might be considered the largest firms. Your Goldman Sachs, Morgan Stanley, JP Morgan, Credit Suisse, for instance, Deutsche Bank. The Tier 2 firms would be considered slightly smaller firms, but still very sizable, but perhaps just doesn't have the breadth and scope that the Tier 1's ultra-large firms have. So whenever you hear the term bulge bracket investment bank, that typically refers to the largest, most prestigious firms out there. And again, within there, there are also several different tiers. Boutique investment banks are not a high-end clothing store. Not a high-end clothing store. What are they? They typically are small, very specialized investment banks focused on a particular industry sector or niche. Many times firms do not like to be considered boutique. They like to say they are full service still. But at the end of the day, like it or not, the layman definition of boutique simply means that you have a very specific industry-focused industry sector or niche. Typically speaking, because they are a smaller firm, they do not have the large institutional relationships. In other words, they do not have the distribution force to push and sell equity and debt. Therefore, these boutiques typically end up being traditional mergers and acquisitions advisory firms only. Also because they do not, traditionally anyway, have access to a lot of capital. Therefore, that's where if you have a smaller firm who is full service, can provide the public securities issuance, then you may call them a full service boutique investment bank. Now, another common term here that people generally are wondering what exactly does this mean is the middle market. The middle market simply means the market in the middle. Well, now that's kind of funny, and it doesn't really tell us too much, but actually that is pretty accurate. These are the small, mid-sized firms, typically defined anywhere between $1 to $100 or plus million of revenue, or anywhere between 10 plus to about $500 million of value. Now, various definitions will come about based on who you talk to, but the general idea is these are not the tiny mom and pop shops, but these are the sizable firms, but they're not that large. The middle market tradition has always been underserved because the big boys, or the bulge brackets, typically want to get higher fees. So if they're going to go ahead and place a deal team to work on a deal, there's a lot of opportunity cost behind that. They want to make sure the fees are high enough, because working on a deal in the middle market can be just as, sometimes even more difficult or more time consuming than working on a large transaction. And therefore, typically the middle market is considered to be underserved. Hence, you have a lot of these boutique investment banks who now try to focus and fulfill this particular sector or industry niche or market. Now, what exactly is a boutique middle market investment bank? Again, this is your small investment bank who is catering specifically to this underserved middle market